Well, futures edging higher pre-market here as we're just about 20 plus minutes outside of the opening bell. This comes on the heels of a major tech sell-off, pushing the Nasdaq 100 to its worst day in more than a month here. Now, the market is already on a bit of shaky ground ahead of the Fed Chair Powell's testimony on Capitol Hill, set to kick off in just an hour. So how should investors be positioning themselves in the market? For more on this, we've got Peter Tchir, who is the Academy Securities Head of Macro Strategy. Peter, great to get some of your insights as always here. Perhaps we start there. And with the day that we saw yesterday, how do investors who are trying to figure out, okay, is there something broader that's taking place, or is this simply some profit taking, especially at the levels that we've been watching in high and lofty valuations?
So I'm a little bit nervous about markets. I think the propensity is to have a 5 to 10% kind of move down, much more than another 5 to 10% move higher. We've seen some of these names stretched. I think, personally, it's a crusade to get rid of the Mag 7 moniker because it really hasn't been working this year, right? It's really been much more about AI and what we've been calling AI deputization, where you see names like NetApp and Dell demonstrate that they have some value to the AI space, so they're doing very well. So I think for this to really broaden, really continue, you really need to see success stories on people using AI. And I think it's been mixed there, whether you're getting that cost benefit. So that's why I'm a little bit bearish. I think Powell's going to have to be very cautious. And I'm watching DC to see if it gets, divisive at all, because this year it does seem monetary policy is now also a political issue.
Peter, you mentioned the fact that you think Powell has to remain cautious here in the testimony today. Is the Fed in control of the market at this point in the rally? And I bring that up just because of the momentum trade, obviously, to the upside here. Anything that the Fed does, or is it necessary, I should say, for the Fed to cut rates in order for the market to keep moving higher?
No, I don't think it is. I think we're in that right sort of frame where we know rates have likely peaked, and at some time in the next year or two, they're likely to come down. If they go up, it's probably because the economy is doing well, jobs are going, great, so we can probably absorb that. I'm probably more nervous if they have to cut more than a couple times this year. It's because the economy really slows, so we might not weather that storm very well. So I think they're actually a minor actor, and it's much more about figuring out, is AI real? How's it going? Where's it continuing? And we all know it's real. And 3 and 5 years down the road, it's going to be better. But are people getting the cost benefit right now? And do valuations make sense?
All right. So if generative AI is not the top theme of someone's portfolio, then what should be from your purview?
So what I've been looking at for the last 6 months to a year, and I think it's starting to take its toll on the market, is what is China going to do? And my view, and I work with 18 retired generals and admirals, so we have kind of some pretty interesting geopolitical insight. China's way out of their morass is going to be trying to sell their own brands. So we're calling it going made in China to made by China. And I think part of that is going to be an effort to suppress sales of US brands within China, elevate Chinese brands within China, but then start moving that beyond that. And if you go back to the Super Bowl, I can't even remember the name of the company. They had 4 or 5 Super Bowl ads, right? Temu, that's it. I was afraid I was going to pronounce it horribly. So I think that's all stretch. And I think where it's going to hurt is U.S. companies selling into China first, and then also U.S. companies selling into emerging markets, because China has a lot of trade surpluses with these countries. So I think that's where they're going to make this push, where they offer maybe it's a value versus quality trade-off in pricing. And I think that could be successful. So I'm a little bit cautious. And the news we've seen on a couple of the Mag 7 stocks seems to play that out, right? Their China sales are going weaker. That could be problematic.
Peter, when it comes, though, to the crackdown that we've seen from the U.S. government, obviously Biden's strategy, if we see a change up in the White House, not likely to change too much the narrative here towards China. How much do you see the results of the election really moving the market in terms of the expectations and where we could see some of those opportunities?
I think China is going to be very difficult. So I think, I don't mind owning Chinese stocks right now for a trade. I think they're going to figure a way out of this. I think it's not going to be great for us. But there's that ongoing friction, and it's going to be difficult to sell chips or high tech into China. And it probably should be, given that state. So I'm looking for, other industries. And again, if this AI is really proving the efficiencies, we should see a much more broad rally. We should see, the Russell 2000, the S&P average, PE go higher, excluding the stocks that have been driving it. So that's where I'll be looking, as more broad rally. My big concern is, though, we get yields selling off, because I think the one thing as we think about this election, no matter who wins, we're probably going to see bigger deficits. One might be more because we cut taxes. One might be more because we raise spending. But I think as it sinks in and the campaigning starts, we're all going to realize we have higher deficits. So I think we're going to see another period like we saw last fall and see the 10-year crack above 5, maybe even 5.5% as that fear hits in, probably early to late summer.
Just to pick up on that, because this actually perfectly tees up our next conversation, Peter. Just lastly, you mentioned monetary policy as a political issue in this coming general election here as well. What should investors be watching, listening closely for that could steer perhaps their own portfolio strategy as they move to and then through November?
So I really think it's going to be difficult for the Fed to cut in September or November. They might say they want to, but I believe President Trump has already come out saying that that would just be there to help the Democrats. So I think we have to be, if we're going to get a cut, it has to come in the June, July meetings, and it's probably only 25 each. If we don't get that, I think you really have to go to the position that we might not get a rate cut for the rest of this year. So I think that's kind of the messaging I'm looking for. Are we going to get something sooner? And if he starts talking about end of September, November for a first rate cut, I would bet that doesn't happen, because that would play right into the election fears that some people are going to have.
All right, Peter Tchir, always great to get your insight. Thanks so much for hopping on with us this morning. Academy Securities Head of Macro Strategy. Thanks.